Most of the forex traders don't understand that you can earn profit and also at the same time the broker will be paying you. Today's video I will explain how the broker can pay you when you trade a currency. The process of the broker paying you is called interest rate swaps, or you can call it swap rates, or you can call it rollover rates. And this trade is called carry trade. So what are swap rates? These are difference between interest rate of two countries. For example, the US has an interest rate of 4.5%, while the South African has an interest rate of 7.25%. So let's take a look. You see the US has an interest rate of 4.5%, while you can look at the euro. Euro has got interest rate of 2.15%. So the difference between these two interest rates, that is what we call the rollover rates. That's the difference between these two rates. See all this. This shows the interest rates of of countries. See the UK has an interest rate of 4.5%. So the difference between 4.25% and 4.50%. That's the meaning of swaps. Those are the interest swap rates which I was talking about. So let's dive deep in this video and understand more. In the forex trading, swap rates or rollover interest are interest paid or earned for holding a trading position open overnight. As you can see, for example, if you have bought Euro USD, so when you hold it today, you hold it the day after tomorrow, you hold it the day after tomorrow. So the different interest rates and whether you're buying or selling, this depends on whether you pay the broker or you'll be paying the broker. So first, let's take a look on how it works. For example, when you trade forex, you essentially borrowing one currency to buy another. If the currency you have bought has a higher interest rate than the currency you borrowed, you will earn interest. So what are these interests called? They're called positive swaps. So for example, right now, for example, let's take a look at USD South African rand. South African rand has an interest rate of 7.7% right now, while the US has an interest rate of 4.5%. So let's take a look at this on the chart. For example, you sold the South African rate from around here, from around 19.0, the price of 19.0, and you hold it until here, until the price of 17.44. So while you are selling this pair, you end profit from 19 to 17. That was a huge, massive downside. So you end the profit from selling this pair, but you will not also earn a profit. The broker will also be paying you due to that you sold this pair. You that South African has a big interest rate compared to the US. As I said before, South African has an interest rate of 7%, while the US has an interest rate of 4.5%. So what does it mean to the market? This means that you will also earn the profit from trading this pair since likely April until to June. So the 2 months you hold this pair, you earn profit for holding this pair due to the direction of this pair, but you'll not also earn profit. You'll also you'll also you'll also earn swaps. The broker will be paying you due to the difference between these two variations. These two variation. Okay, let's continue. If the currency if the currency you buy has a lower interest rate, you'll be paying interest to the broker. So let me clarify this. What are these? When you pay interest to the broker, these are called negative swaps. They're called positive swaps due to the broker will be paying you. But now you are paying the broker due to the position. If you hold your, as you say, these swaps rates are you're holding a trading position open overnight. So if you hold a trading position overnight and that trading position you are buying, so you're paying the broker depending on the market. So let's look like we are buying Euro USD since since February until currently now. Yes. Okay. While we are holding this position enjoying the profit due to the difference in interest rates between these two pairs, as I said before, the US has an interest rate of 4.5%, while the euro has an interest rate of 2.15%. This shows that the US has a big interest rate compared to the euro. So while we are earning profit through all these months, but we are also paying the broker. We are also paying the broker. This interest is called negative swaps. Due to that, the broker will be taking some of our capital depending on the difference of on these pairs. This pair. So let's look on how it's calculated. Swap is calculated based on the interest rate differential between the two currencies. Trading pair, the position size, and whether you are buying or selling. Okay, let's look at the example. Let's look at the example right now. For example, we are buying USD. Let's take a look at the USD. We are buying USD, right? We are buying Euro USD. Euro USD. We are buying Euro USD. Okay, Euro USD. We are buying Euro USD. And the USD has an interest rate of 4.5%, while the euro has interest rate of 2.15. So we are buying the USD since February, as I said earlier. We are buying USD since February, currently until now. Okay, let's look at the swaps. Because current directly here, when you look at this pair, we are going to you'll be paying the broker negative swaps due to we are buying here. This broker which I'm using, take me. When you long USD, you'll be paying a broker of negative 8.83%. While when you short the USD, the broker will be paying you a positive swap of 5.63. But according to the macroeconomic data, what is happening to the market right now, you cannot sell the USD. You will be buying the USD due to the currently market approach, economic market approach going on currently on these two countries, which directly will affect these pairs. So how are you going to pay the broker here? Let's clarify here. You're paying a broker negative 8.83, and this is depending on a lot size. For example, you bought USD on a lot size of 0.1. You take 0.1, you times the 8, the swaps, you should be paying 8.83. So currently every day you'll be paying a broker you'll be paying a broker 0.883. Let's say 0.889 swap, negative swap. So if you hold this pair for maybe 3 months, which let's say 60 days. So currently you'll be paying a broker negative swap of $52.93, depending on your currency chosen to trade. So the broker will take that from your account, 52.93. So let's take a look. If you are buying if you are selling the USD ZAR. Let's take a look at the USD ZAR. If you are selling the USD ZAR, you see, when you long the USD ZAR currently, you'll be paying the broker negative 187.4. But if you short the USD ZAR, the broker will be paying you a positive swap of negative 73.53. So let's take a look. We're using a standard lot, 0.1 times 73.53. So every day the broker will be paying you a $7, depending on the currency you're using to trade. Let's say you're using dollars, your account is in terms of dollars. So the broker will be paying you $7.35. So every day the broker will be paying. So let's times by the 30 days. 30 days a month. So by the month, the broker will be paying you $220. You see, let's take a look. Like hold this pair since for like let's say 6 days, as we did on the USD. The broker will pay you for the 6 days holding the pair. You will not also, apart from the profit you'll earn, but also the broker will pay you $441. So this is what I was telling you about. $441 for trading USD ZAR, and you'll be paying the broker for buying the USD. This is because of a different on the interest rate differential, as I said earlier. So the other thing right now, let's look at something called the overnight. Let's look at something called the overnight. What are overnights? Okay, let's look at something called overnights. Overnight swap is applied when you hold a position past the daily rollover time, when it's usually around 6 o'clock in the meantime, saver time. So how do you get these swaps? These swaps, as I said earlier, is when you trade a position open overnight. For example, you trade a position 3 months. So every day when it's past the saver time, which is 6 o'clock, let's say 12 o'clock at the midnight, the broker directly start paying you according to you. Is a positive swap, is a negative swap. If you sold the USD ZAR, means that the broker will be paying you a a positive swap. If you bought the USD, the broker you will be paying the broker. So things like that overnight. So let's take a look at the other thing called triple swaps. Guys, as I said, triple swaps. Let me clarify this more. Triple swaps. What are triple swaps? On Wednesday, most brokers apply a triple swap to account for the weekend, as traders settle on the weekend and are rolled over to the Monday. As you know, guys, we don't trade on the weekend. Saturday and Sunday we don't trade. So As I said, the broker pays you every day. So when the market is closed on Friday on Friday night, so from Saturday, the swap which you're supposed to pay the broker, or the broker is supposed to pay you on Saturday and Sunday, will be paid on Wednesday. So on Wednesday you'll be paid three times. Also, you either pay the broker three times, or the broker will pay you three times, depending on the currency movement and where you are heading. So this is so. For example, on Wednesday you're supposed to get a $7 for the euro for the USD ZAR, so you'll get 21. Things like that is what is meant by triple swaps. So the other thing, let's look at the impact. Let's look at the impact of. Let's still look at the impact on trading this thing. Swap rate can significantly impact your trading results, especially for long-term position. As I said before, you are trading long-term. You see long-term here, as I said on the USDs are long-term. First, it leads to capital growth. As I said, from the profit end while holding the pair over a long period of time. Also, you earn swaps. Also, so for example, we saw this pair, as I said, until here. So we earned profit also, but we didn't earn profit for the month which you hold from. It was around April till now here. Let's say it's at July, so it's 3 months currently. So you earn $441. You see, so from the profit you earn while selling this pair from here to here, you'll also earn swaps. So this means it will grow your capital. You'll have a growth on your capital. You see, from apart from the profit, you also earn swaps. This will be given to you. The other thing is to reduce risks for pairs traded where you had to pay the broker due to interest swap differentials. You can cover the capital loss. For example, right now, this is your trading account. At the same time, you bought the Euro USD, and at the same time, you sold the USD ZAR. So while you are paying the broker negative swaps for you're paying the broker negative swaps for buying the Euro USD, for buying the USD, and the broker also pays you a positive swap for selling the USD ZAR. So the negative swap which you saw we are paying on the Euro USD, we are going to cover it by selling the USD ZAR when the broker is going to pay us. And let's look at the different differentials between these two pairs. The USD ZAR, when you sell it, the broker is going to pay us 73.53 short position, but depending on a size, a lot size, you say 0.1, a standard lot. So it's going to be seven $7 each day. Let's look at the Euro USD. Let's look at the Euro. Let's look at the Euro. 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 USD. When you bought the USD, the broker we are paying the broker negative 8.83. So according to standard lot size, you every day on the Euro USD for the 3 months holding the Euro USD, for the 3 months holding the Euro USD. Let's take our calculator. 0.1 standard load times 8.83. Mean each day we are paying the broker $0.89. So let's times it by 60 days, 3 months. So we have paid the broker negative source of $52. While on the USD 3 months is four $441. So you see the capital which we paid buying the USD, we have covered it on the USD ZAR, and we have got a huge profit. You see the difference between $52 take away $441 take away $52. So you have got a profit of $388 standing. So you see it reduces risks. That's why I say it reduces risk, and it leads to capital growth. It leads to capital growth. Okay. The other thing you're going to look at is swaps a good or bad? Is swap good or bad in the forex? Swap is one way a broker will lose money. You see, I told you guys, and this is special for unregulated brokers. Unregulated brokers don't give swaps according to the rates. They manipulate you. That's why I always tell you, and I'll keep a link on my video explaining about the forex traders brokers to look at. So they don't want for traders to know. So whenever a trader knows how to use these swaps on the advantage, this broker doesn't want you to know. So it's a good thing that you know this thing, and I've put it to you to enlarge your knowledge about this rollover rates, interest swaps. So I urge you to use regulated brokers. The last thing you're going to look is factors affecting swap rates. Factors that can influence swap rates, such as economic indicators. You know, guys, the forex market is not about support and resistance, guys. You must know the macroeconomic indicators. These things are the one who form movement, are the one who form market price. The difference between economic indicators, macroeconomic approach between the two currencies, maybe say the USD and South African rand. That's what led to a big sell-off of the South African rand. The difference between the macroeconomic approach between the euro and the USD currently, that's what led to the buy on the euro USD, a sell on the DXY futures, or sell on the DXY. So these things. So whenever this macroeconomic changes, for example, currently right now the macroeconomic approach changes. The US start raising rates. The US start raising rates maybe. So what will lead and the euro raise rates, but the US raise rates on a higher than the euro. This will lead on the US to have a strength in the market. So we are going to sell the USD. Also, interest rates means that the broker will be paying us. So things like that. And the other things like the central bank policy, as I say, the central bank factors everything in the market. And you can say your political events. So these things affect the interest rates of currency. This will lead to affect the swap rates. So guys, all about today, I want to talk about these interest rate swaps, and I hope this video will be helpful to you. And please don't forget to subscribe to my channel, like my videos, and comment on my videos. And please, those who want to work with me, check out my email on my video link and also on my bio. Let's keep on sharing this knowledge. Let's keep on opening mind on forex traders, guys. I always say it, and look all my videos concern the forex market. Forex is not about support and resistance. There's a lot more. There's a lot more. Just look at the macroeconomic, guys, macroeconomic approach, and I will continue making videos to continue enlightening you more about this approach, guys. You cannot just look at the market and say that price was here, price was here, price was here. Yes, these things happen, but you must know from a banking type of view what makes this currency go up. So is it the right time to buy the USD, or is it the right time to sell the USD? Is it the right time to buy GDP USD? Things like that. So let's grow this macro market FS community, guys. Please don't forget, I'm repeating again, don't forget to like my channel, like my videos, subscribe to my channel, comment on. Let's grow this community. I want you to know more about the market, financial market, and all. I also drop stocks stocks on different stocks. I've dropped the PR stocks, which currently now we are in a good position. I've dropped the SBP stocks. You can look on my videos. I'll keep the link on my bio of this video, and also let's grow this community. So have a great week. Thank you.